Hello and welcome to Market Domination. I'm Josh Lipton, live from our NYC headquarters. Volatility ebbing on Wall Street despite rising U.S.-China trade tensions and brewing trouble in the banking industry. We'll have a lot more on those stories. But right now, there's just an hour to go until the closing bell, and stocks are higher. We've got green on the screen. Let's look at the Dow here. Up about 300 points. The S&P 500, your broad gauge, is up about 0.6%. And your tech-heavy NASDAQ also up about 0.6%. Let's welcome in now our data and markets editor, Jared Blickery, to break down the headlines. Jared, what are you seeing, my friend?
Thank you,
trading
John.
action?
You bet. Not only are we seeing green today, we're seeing it for the week. All the major indices up about 1-2%, along with the Russell 2000. I'll do a recap after the bell, but this is today's price action. A little bit of red earlier on, but we are at the highs of the day, up 0.7%, just over 300 points, as you were pointing out, Josh. The NASDAQ up about 0.5%, spent a little bit more time in the red early on, and the S&P 500 also up about 0.5%, very similar chart there. And I'll show you the Russell 2000. So the small caps are down today. They were down big yesterday on that regional bank scare, but you take a look at the 5-day, still holding on to some nice gains there. We hit that record before, and so I'm not going to say smooth sailing, but the market has shook off a lot of volatility and a lot of hiccups this week. We'll call them that. Here's the 10-year T-note yield. I'm going to dial this back down to a day, and you can see it's up 3 basis points to the round even number of 4.00%. 30-year is at 4.6%. It's up a couple of basis points. And I'll show you the VIX. Pretty big day in the VIX. We started out around 28, 29, and we were back down to 22. Still above 20, so a little bit elevated, but I think traders will take that, and the markets, the risk markets, are running with that. And in the sector action, we have staples. You don't always see defensive sectors like that leading by this much, but up 1.3%. Financials up 1%, consumer discretionary, energy, communication services, healthcare, all of those on the top row, outperforming the S&P 500. To the downside, utilities and materials. And taking a look inside the NASDAQ 100, pretty bullish picture. We got Apple down there up 2%, so is Tesla. And I'll drill down inside the tech industry. Semiconductors, you're seeing a mix of red and green. Intel up 1%, Nvidia also up about 1%, but software much, much stronger. And so you noticeably, Oracle's down about 7%, but we got Intuit up 2% and a few outliers there. Looks like Workday's up almost 3%. And I do want to show you before we go here the regional bank market, because that was what was in trouble yesterday. And you're going to see it's a sea of green today, a little bit of red there. But if you take a look at the 2-day, well, it's still a lot of red. So there's some losses to be clawed back. But all in all, most of the trouble that we've seen over the past week, even in China, has been erased. And we're seeing a little bit of remnants in the regional banks, but a lot of improvement over the last 24 hours, Josh.
All right, thank you, Jared. Well, to Washington policy now, President Trump working to calm those Wall Street jitters, saying that his latest threatened tariffs on China are, quote, not sustainable. Treasury Secretary Bessent also expressing optimism that talks with China could solidify a broader trade deal. Let's get to our Washington correspondent, Ben Werschel, for more. Ben.
Yeah, Josh. So we've had a bit of a roller coaster week on U.S.-China relations, with the clear signs today that things are, at least from Trump's rhetoric perspective, on the upswing. We've seen Trump in a couple different forums today, including just about an hour ago at the White House, offering really kind of optimistic commentary about where things stand with China, at least for today. For one, this off again, on again meeting with President Xi Jinping of China and South Korea is now apparently on again. Trump said just a little bit ago, it looks like it's going forward. He also raised the possibility of some sort of agreement when the two leaders gather. They're set to talk on the sidelines of a summit in South Korea at the end of this month. Treasury Secretary Scott Bessent also announced today that there's going to be a kind of a series of talks leading up to that meeting. The first one is going to be actually this evening here in Washington on the sidelines of the IMF annual meetings. And then there'll be a follow-up next week at about a week's time in Malaysia. This is between Bessent and China's vice premier, sort of the two top trade officials there. Overall message here is things are looking good, and it comes a week to the day after Trump kind of surprised markets to the downside with this idea of a 100% tariff, an additional 100% tariff on China over rare earth minerals and supply chains that China is looking to restrict there. Worth noting that Trump didn't take this 100% tariff off the table today. He even discussed moving it up ahead of the November one that he's promised. But the overall message you're hearing from Trump and Bessent, for today at least, is that things are looking on the upside. The relationship between Trump and Xi, they're confident at least, can kind of bring the sides together and at least maintain the status quo for the time being.
And Ben, while we have you, we know Vladimir Zelensky in Washington today with President Trump. After Ben Trump's remarks, Russian oil exports, India yesterday, what did we learn today?
Yeah, we learned a bit today. So this meeting, as you mentioned, was Trump with the Ukrainian president talking about the war in Ukraine, with oil clearly a big element of it. As Trump has talked about this week, Trump claims that India is going to stop its purchases of Russian oil, which would then pressure an end to the war. If that goes forward, it's a very significant economic lever to use against Vladimir Putin and Russia because of how reliant Russia is on oil revenues. Trump reiterated that claim today. He talked about how India, in his view, has already de-escalated, even as Indian officials aren't going quite that far. There is evidence that Indian suppliers are buying a bit less Russian oil, and that's going to continue. But there's no promises from that side, at least, of zeroing out. But this is clearly a lever here. Zelensky was also talking about oil, talking about meeting with energy companies for infrastructure projects going forward. So there's a real tie-up here between the energy diplomacy, the tariff diplomacy, all these kind of things intertwined, as Indian officials are also in Washington this week, just to make things even more complex, with at the IMF meetings to talk trade as well with the Trump administration. They're trying to get a 25% tariff over Russian oil lifted, and clearly both sides are trying to kind of find a middle ground there.
All right, thank you, Ben. Appreciate it.
Thank you.
Well, our next guest says the Fed is moving closer to wrapping up its balance sheet runoff, even as tariffs add a new wrinkle to the central bank's outlook. Oscar Munoz, TD Securities Chief U.S. Macro Strategist, joining us now. Oscar, it is great to see you. I actually wanted to start, Oscar, with these bank credit concerns that were front and center yesterday, Oscar. But today it is a different story. I'm just looking here at the KRE, the regional banks ETF. That's in the green right now. I'm just curious, Oscar, listen, you were seeing those headlines and reading those stories too. I'm curious what you made of them. Did you think, okay, these are one-offs, nothing to see here, or no, Oscar? Or did you think, hey, potentially something more serious, systemic?
No, I think I have to agree with your first point. I think it's probably a one-off. We know that the Fed has been paying close attention to small banks, regional banks, since SVB in 2023. So I think they have a pretty close understanding of what's happening to those regional banks right now. So I don't think there is a lot of concern. I think the Fed right now, in terms of the meeting coming up, I think they're just thinking about first balance sheet runoff, as you mentioned first, and I think also another rate cut that should be in the cards following the first rate increase in the last FOMC meeting.
Let me ask you, Oscar, another headline that my colleague Ben there was just talking about was U.S.-China trade tensions. President Trump on Friday, he's saying, listen, the threatened high tariffs on Chinese goods, he says, not sustainable. I think perhaps easing fears of further tensions between the U.S. and China. I'm curious how you're thinking through that, Oscar. I had another investor on the show this week, and I asked him, just as an investor, how he thinks about these trade tensions. You know, he told me, Oscar, he actually just looks right through them. He thinks they're headlines. He thinks they're noise. He's just focused on earnings. Is that how you see it?
Yeah, I think the market has learned quite a bit how President Trump behaves. He's very transactional. Post April 2nd announcement, Liberation Day, I think the market understands that the Trump's tactic is escalate to de-escalate, right? We had that tweet last week. We now learned this week that he knows those are not sustainable tariffs for China. The retaliation from the Chinese through soybeans, rare earth minerals, it would be hurtful for the U.S. So I think this is just a starting point for negotiations. Hopefully they get to a better place over the next couple of weeks. And I think that's how the market is reacting to it as well. I think they've learned quite a bit how President Trump tries to approach these kind of trade topics. And they know at the end, he's going to look out for the best in terms of the U.S. economy.
Oscar, I want to also talk about earnings. You know, we're getting right into earnings season here. We're in the thick of it. We heard from the big banks. I think broadly, you looked at the big banks, Oscar, they were generally solid. I'm curious, listen, still early days, but what do you make so far of what you're hearing from companies?
Look, I'm actually interested to see the profit margins, how they behave in Q3. We have, at least our expectation is that we're going to see more tariff pass-through to consumers to the extent that businesses continue to absorb most of the tariff shocks, in particular sectors like retailers, industrials, the auto sector. I'd like to see how those profit margins behave. If they continue to absorb it and not pass it through to consumer, that means that profit margins have to decline. To your point, I think banks kind of signal things are going well. They're doing okay, particularly when talking about the U.S. consumer. Apparently, it continued to do well over the last few months. But again, I think profit margins in Q3 and in Q4 this year are going to be very important in terms of how we understand the pass-through from all these increasing in tariffs to our bilateral trade partners.
You mentioned the Fed, so let's get to your forecast there, Oscar. You forecast the Fed cuts this month and December, and then it looks like you pencil in 3 more times next year. How much confidence do you have in that call, Oscar? Because I've heard other economists kind of less confident. They say, listen, inflation's still running above target, and it seems to them that we're kind of running sideways here.
Yeah, look, it is very uncertain times. We're talking about tariff pass-through. There is not a lot of conviction there. There's actually signs of the labor market conditions weakening as well. As you mentioned, inflation remains above target. So it is really a tough time for central banks everywhere, particularly for the Fed. I think confidence for me is that if you look at what Fed officials have been saying, particularly the core of the FOMC, so Chair Powell, Governor Waller, President Williams, they continue to say that they want to move closer to a more neutral stance. They think that monetary policy remains restrictive, so they want to move there. So the highest conviction that I have is that we probably have 1 or 2 more cuts in the cards for sure. So I think October is pretty much set. I think December is very likely. Then apart from that, thinking about Q1, Q2, it's really going to come down to the data, both on inflation, but particularly labor market conditions, given that the Fed is more focused right now on the employment mandate rather than on inflation.
Get you out here on this, Oscar. I also saw you say the Fed is likely to announce the end of quantitative tightening at this October meeting. Why now, Oscar, do you think? And what would that mean for the rates market?
Yeah, so I think, you're seeing funding pressures emerge. So the Fed funds rate increasing again today. I think it's no coincidence that Chair Powell, spent most of his speech this week talking about balance sheet, talking about runoff, talking about QT. I think that's clearly a prelude that they're closer to making the announcement. That's why our expectation is that the Fed will announce at this month's meeting that they will be ending QT in December. They don't want to go back to that experience they had in 2019. They don't want to surprise markets. They don't want an adverse reaction from funding markets. So I think they're just going to be moving ahead a little bit. We know that they want to get from an abundant, reserve system closer to an ample system. And I think we're getting there. And I think the rates market will be reacting to that as well. I think given the, Chair Powell's speech and focus this weekend, the rates markets have already reacted to that. I think there is some uncertainty whether they announce it this month or next, but that's certainly coming. I think the rates market has been paying attention to that.
Oscar, great to have you on the show today. Thank you.
Thank you.
Coming up, Amex's new Platinum card benefits are being well received. We'll tell you more about why the credit card giant is having a good day. Plus, the government shutdown dragging into another week. The markets haven't been heavily hit, but what will be the breaking point for lawmakers? We'll explore that. And will record deliveries boost Tesla's third quarter results? We're giving you a preview of everything you need to know ahead of the EV makers' earnings next week. Stick with us. Time for today's trending tickers. Yahoo Finance's Brooke DePalma joining me here for a look at Jefferies, American Express, and CSX. We're going to start off here with Jefferies. Oppenheimer lifting its rating on that stock from market perform to outperform. So they are now believers Brooke DePalma, they go to outperform. They say the recent Investor Day presentation compelling. They say gave us increased confidence in the company's long-term trajectory. The target is 81.
Yeah, so this comes after Jefferies actually downgraded by Oppenheimer earlier this year, back in March. They said that was based on fears that an expected major rebounds in M&A activity would fail to materialize, and so they downgraded the stock back in March. Now they're essentially moving, ahead with reaffirming that upward guidance. But also, it's important to note here that within this note that Oppenheimer put out around Jefferies, that they called it an undervalued and underfollowed mid-cap financial services growth company. And what we saw over the past few days is Jefferies really get looped into this major concern around regional stocks because of the ties that Jefferies had around First Brands. That was an auto parts supplier that collapsed, filed for bankruptcy in September. And that really spooked the street here. But now Oppenheimer saying, hey, this is the good potential buying opportunity here. And they noted that Jefferies does not have a specific issue with its First Brands exposure, and they think it's relatively very limited exposure there. And so they're looking at now it's time to buy.
Yeah, investors shaking off those concerns today. Just look at the KRE,
Absolutely.
well in the green in today's trade. All right, let's turn to American Express, company reporting better than expected earnings and an upbeat outlook, Brooks. So this one, all right, so earnings beat is the Platinum credit card refresh last month. $421 billion in billed business. That was better than the street had been looking for. Initial demand for that refresh card exceeding the company's predictions. Strongest start we've ever seen with a refresh, they say.
And pretty insane considering the amount of attention that it got around that card. They know that their annual fee around this card increased from $695 to an annual fee of $895. And that really, sparked a lot of conversation, especially online. But what we're seeing here is that they did raise their lower end, they boosted the lower end of their full year outlook. So they're essentially expecting, this to really see a return within the coming year in 2026. They said that card fee growth moderated as expected, but will continue to moderate, but they do see an inflection upward in 2026 because of this refresh. So net card fees were up 17% based on a foreign exchange adjusted basis. They also, added all these different perks that did really well as well. It also got attention like that dining credit around Resi. That seemed to be a big boost for them. And also that Lululemon credit. Well, that had people taking to social media saying that they were now going to get the Amex to get that, I think it's like $75 per a quarter when you think about it though, and Lululemon's kind of expensive.
Yeah, so. And earnings likely to see total $15.20 to $15.50 a share now, it looks like. So up in today's trade. All right, lastly, railroad company CSX beating revenue estimates for the third quarter. Investors are also looking at strategy the company's CEO might take. So CSX reported revenue for the third quarter came in just above consensus, Brooke, $3.59 billion. Bloomberg analysts weighing in, saying the earnings performance overshadowed by curiosity surrounding this new CEO.
Yeah, he joined just last month, I think.
Well, replaced the last CEO, I guess, following activist pressure. And Bloomberg saying unclear to the analysts what he's going to be doing differently, they say, but should be apparent, I guess, once he's on the job for a little bit longer.
Right, and over the past month, the stock is up 13%. So certainly investors looking at this as maybe a potential opportunity of a turnaround story here. CFRA said the stock presents a compelling investment opportunity as the company emerges from a transformative period with significantly enhanced operational capabilities. That operations metric was something that got a lot of attention in the call. They said they have their fastest train velocity since 2021. They're seeing lowest wait times since mid-2023. And also they have major infrastructure projects that are now completed that eliminates about $100 million in annual disruption costs. And what also got a lot of attention on the call is just this overall trend that we're seeing within the industry. When you think about that deal between Union Pacific as well as North Fork Southern, analysts on the call were saying, hey, are you guys next? Are you looking for other merger opportunities? And the CEO wasn't too quick to say, but he did say that essentially the way things work, these strategic opportunities, you got to wait for the right timing, he said. You got to wait when the conditions are right. And so investors may be a little bit excited about that too.
Yeah, most on the street still like this one. I see 21 buys, 7 holds, not a single sell, Brooke, not a single bear for this one. Thank you. Appreciate it. Well, no end in sight yet for the government shutdown, which is now tied for the third longest federal work stoppage in U.S. history. The stalemate in the Senate continues as there's yet to be a catalyst to push for a reopening here. Let's talk about it with PIMCO head of U.S. Public Policy, that would be Libby Cantrell. Libby, great to see you as always. So I think this shutdown, Libby, I think it's day 17, Libby. So how much longer? I mean, is it a week? Is it a month? What are you telling clients? Lay out the scenarios for us.
Yeah, well, nice to be with you. I mean, I think just to your earlier point, this is actually the longest full government shutdown. The other longer shutdowns have been partial shutdowns. So this shutdown has already made history. The sort of apples to apples comparison was back in 2013, which when the government was fully shut down for 16 days. And again, now we're going on the 17th day. I don't think there's really a real end in sight. I mean, this will depend, obviously, on both sides, but the pain tolerance for this shutdown is much higher than in previous shutdowns. Republicans very comfortable with their position, and so are Democrats. They are comfortable effectively not lending their vote to reopen the government in order to shine a spotlight on these ACA subsidies, these Obamacare subsidies that are expiring at the end of the year with notifications going out in November. So they're betting that even though voters don't like shutdowns typically, that they will reward them for, again, bringing attention to this issue, which does poll very well. So long way of saying it doesn't look like the House will be back next week. So at a minimum, that means that we're looking at the end of the month. We're telling clients November, maybe even Thanksgiving. But again, one side can capitulate tomorrow, in which case the government will reopen. But that does not look like it is imminent, at least at this point.
Do you see, Libby, is there any kind of specific pain point that could be coming that would pressure this to end? Turmoil at the airports, SNAP benefits. Do you see anything like that on the horizon?
Yeah, I mean, I personally was sitting on the tarmac at Reagan National last night for 4 hours because of some of the disruptions at ATC. So I do think that as those disruptions are more widespread, and if you remember that back in 2018, 2019, when the government was shut down partially for 34 days, that was what ended up reopening the government. It was issues with the FAA and air traffic control. So certainly that could put pressure on lawmakers to reopen the government. One pain point could have been the fact that 1.3 million active military folks would have missed their payday 2 days ago, but the president and the administration reallocated some money at the Pentagon in order to pay those people. So that sort of minimized that potential pain point. But again, we're looking, I think, theoretically, at least, into November. That is when I think Democrats are hoping that these more attention comes on these ACA subsidies. That's because a lot of folks will be notified that their premiums are increasing. And so I think they believe holding out until then makes political sense. But again, it looks like there will be more disruptions, at least at the airports and elsewhere in the government, which will have, I think, from our perspective, could potentially have meaningful impact for the economy that may not be reversible, unlike what the market assumes at this point.
Well, I want to, end there, Libby. What are the implications that we as investors need to think about here? The effects of all this on the economy, on sentiment, on the Fed. What should be on our radar?
Yeah, so I think that this is the sort of the issue. I think markets have, understandably been kind of shrugging this off, political dysfunction, what have you, any economic impact largely reversible. That I think is probably true. However, the longer the shutdown happens, and because this is a full shutdown, meaning it's impacting about 1.5 million workers who are either working and not getting paid or furloughed and not getting paid, you could see changes in their consumption behavior. One missed paycheck, maybe not that big of a deal, but continuous missed paychecks actually will make a difference in how these folks consume. And 80% of the federal workforce, remember, is outside of the DC, Maryland, Virginia area. So this is not just a kind of localized impact. This could be more broadly felt. Outside of just the GDP impact, and we estimate if this goes on until November, you could see a point shaved off. Again, some of that will be reinstated, but some of that could be just lost. GDP activity. But in addition to that, for a market's perspective, we're not getting any data. And that, I think, is the big rub. Not only is the Bureau of Labor Statistics not releasing data, they're also not collecting data. And that could make the Fed's decision, come FOMC and end of October, that much more difficult. I mean, we assume they will cut then, but they are not going to be getting at least a complete picture of what is happening in the economy. The last thing I'll just say is, of course, our view is there's sort of a window of weakness in terms of economic growth here. There is labor market fragility, and this could just add a kind of another wobble, if you will, to that, to that kind of that weakness or that fragility.
Libby, always great to see you. Enjoy the weekend.
Thanks, you too.
Coming up, we've got what you need to know when Tesla reports its Q3 earnings in just a few days. That story and more coming up. Tesla is gearing up to report third quarter earnings. Investors in part looking out for updates on the company's AI promises. Yahoo Finance's Pras Subramanian joins us now with more on what to watch. Pras.
Yes. Will it be the high water mark for sales, right? So top line numbers here, looking at $26.27 billion in revenue for Q3, up nearly $1 billion compared to a year ago on 53 cents of adjusted EPS, right? Also EBITDA coming in at potentially estimates $3.78 billion. So we mentioned sales, right? In Q3, we saw that jump to quarterly record of 497,000 EVs sold. Not surprising given the expiration of the EV tax credit. We expected this pull forward, but it was more than people thought. Also record deployments of energy products. That's also a good high margin business for Tesla. But yeah, I mentioned that sales figure, right? So the cheaper Model Y and Model 3 Standard are going to come out next quarter as well. Is that going to help boost sales? We're going to hear about robotaxi deployments too. We're going to hear more about that, which is their biggest AI play is robotaxis, right? It's not robots are down the line. Obviously, they're kind of pulling away from the data, that whole their whole Dojo supercomputer. That's not happening anymore. They're going to use NVIDIA chips and start doing that for their own AI training and for robotaxis.
Let's about China quickly, because Dan Ives over at Wedbush, Tesla bull of Tesla bulls, we know that. He said this about China. He's already told his clients. He says, we believe the China story is starting to improve markedly for Tesla. And he goes on to say, should be a tailwind for Musk and company in 26. What do you make of that?
Well, we saw a good month of production out of China, the Giga Shanghai last month. Good numbers there. We saw the new Model Y L, which is like the extended version of Model Y, apparently pretty popular in China. Good registrations there. So, I think the brand issues that Tesla faces in China, not really the same as they do in the U.S., right? And Musk is not seen as a negative character there, as far as I know. He's seen as like an entrepreneur and a rich, wealthy guy. Tesla still kind of has some cachet. I think that's why you're seeing that, and the sales numbers are fine there. And that Giga Shanghai is their most productive factory, cranking out cars for all over the world, not just China. So I think he might be right that China is a tailwind for them. The question is, what happens in North America and Europe? Can China overcompensate for any loss there?
All right, thank you, Pras. Appreciate it. Well, Brian Niccol is now over a year into the CEO role at Starbucks, and Yahoo Finance's executive editor Brian Sozzi sat down with Niccol for a closer look at the turnaround journey for the coffee chain.
The Starbucks of today is getting back to being a great experience for customers. We've switched away from, I think, being focused on efficiency and tasks and reoriented the business to being a great customer service company again. And that means personalization for, what's your drink, Brian?
It is now the protein iced coffee.
Okay.
I mean, I go right out of my High Rocks training class, and now I'm having this protein drink. It's a little expensive. We'll take that in a little bit later, but still, it tastes good.
Well, look, I started my day with a protein latte, vanilla latte. So obviously there's going to be more innovation coming that I think is very much on trend. But I think what you'll also find is our baristas are better set up to give you that great experience for that personalized drink that you want to have. And I think that's where Starbucks is today versus a year ago when I talked to our partners, they didn't feel like they were set up for success to give people the experience that they actually expected from Starbucks.
I've joked to you in the past, I followed how you rolled out items at Chipotle. I mean, they're called a stage gate process.
Yeah.
I would hear about this a lot. How have you changed the innovative process at Starbucks? Because before you, they would try this energy drink, and I would order this pink and blue drink, and it tasted like nothing it was as advertised. What are you doing different?
Yeah, look, we are using a stage gate process. It's one of those things that I think when you put some discipline in place around innovation, you end up with bigger innovation that can be executed correctly. And protein's a great example. That really went through our process. That's really the first item that we had the ability to say, let's take this from idea all the way to scale. And on our way, we started in 5 stores. We got a lot of feedback from those baristas on how to make it better. When we got that feedback, we then put it into, I think it was around 100 stores. And then we better understood what's the supply chain necessary, what is the right way to build this, and what is the way that customers want to order it. And so you've seen us make some changes in the app. You've seen us make, I think, some smart decisions in how it's merchandised in the store. And then most importantly, our baristas are set up to execute it with excellence every single time.
What's next? Not necessarily just on the coffee front. How are you reinventing that bakery case when I walk in?
Yeah, well, look, I think you might have heard me talk about this. From the beginning, I said, look, we got to get back to winning the morning. And I think we've done a nice job of setting ourselves up to win the morning. First, from an experience standpoint around coffee and beverages, now we're going to turn our eyes to how do we make the bakery case relevant and more relevant for that morning experience. And so we've got a new bakery case that will be coming out with, I think, more artisanal pastries.
You're not doing away. Are you doing away with my egg bites? So they are
no, that's a staple. So this is more focused on how do we get the pastries right. We've already got some great innovation coming on what I would call like the protein forward breakfast items. The Egg Bites platform is a home run. We need to figure out how we continue to leverage that going forward.
What else protein can you sell? Like food wise?
Look, this is where I think we now have to focus on how do we build an afternoon day part. Mm-hmm. And so it's like win the morning, let's start building the afternoon. And in the afternoon, I think we have opportunities on food to get the right selection of food. And then I also think we have opportunities on drinks to figure out how we can bring the right craft with the right flavors, customized energy, as a matter of fact, even with those drinks and flavors. So, I'm optimistic about what we can do on the afternoon day part while we continue to make great progress in the morning day.
There was a Starbucks, and I think it's still by me in the city. At one point, they were serving alcohol. Are you a big believer Starbucks should be serving some form of drinks with alcohol in it?
Look, I think that's a great example of experimentation that's happening in our roasteries and reserves. We have some fun ideas. I've heard about the matcha margarita.
Espresso martini.
The espresso martini is a crowd pleaser, but there's some fun things we can do, right? Matcha margaritas, the pink drink Cosmo. So I think there's some fun things we can experiment with alcohol on. It's still at a very small level. But, when we strike the right chord, if we have the ability to scale that, we will scale it.
Now you're also remodeling a lot of restaurants. How many are you going to remodel, and what is your hope for these remodels?
Yeah, look, we've done about 100 so far. Our plan is for this fiscal year to do well over 1,000. And these uplifts is what we're calling them because it's really focused on the front of house experience, meaning the seat you would have.
Plants?
There'll be rugs, there'll be drapes, there might be some plants. Like the purpose is to get back to having that great third place. Howard and frankly Starbucks in the beginning of this concept recognized people wanted to spend time in a third place between home and work. And we got to get back to giving people that environment. And I think it's important that you walk through that environment, even if you're going to grab and go. Or if you're pulling up to the drive-through, when you see through the drive-through, the coffee house over there, or maybe next time next time you might want to get in there, right, and grab a seat. So I love what's happening. I always say to people, every coffee house needs to have a couple seats where everybody walks in and says, that's my seat. Like when that person moves or if it's available, like that's my seat.
Have the times changed? Let me just push back a little on this.
Yeah.
I see the next generation, let's say under 20, they're glued to their phones and they're just in a rush. Do they really want that? It's a third place? Like, is there?
Look, I think so. I mean, if you look in our cafes, and especially like after school, call it the 14 to 18-year-old crowd, they need a third place to hang out with their friends, and they want our drinks. So absolutely, and I think actually, if we have more of these third places, maybe I'm being a naive parent here a little bit, but I hope they would put their phone down and connect with each other.
Yeah.
And we're going to provide them that space where they can do it. You're already seeing schools adopt this where, less and less kids have their cell phones in the school because they want the kids to connect not only with their teachers, but with each other. Like you can see a marked difference if you walk into a school And cell phones are not part of their day at that lunchroom, because you know what you hear? A lot more
I
conversation.
think they've taken them away. I'm in Long Island in New York. So
Okay.
There's no more cell phones.
No more cell phones at all there. So, I know I've seen this in various school districts, and I think it's actually, going to be something that the kids are going to find they really enjoy, and then they're going to really enjoy when they have another place to do it outside of school.
Do you want Starbucks to go back to, the late 90s, Friends was on, and people are just hanging and spending 8 hours at a Starbucks, I don't know, living their life? Is that what you're going for?
Look, 8 hours might be a bit much, but I think there's nothing wrong with people finding a moment to connect with each other, or sometimes you just need a moment for yourself. And do it in a place, and I've seen this actually, Brian. I think it's as much a feeling like you're part of the community, where if you sit there and just seeing your community come in and out, and you get to say hi to the neighbor or the friend or the family member, maybe you haven't seen all week or the past month, but you see them in passing in a Starbucks, that's a moment of connection.
But they have to
as well.
buy something. They're not.
Well, yeah,
We're not going back to.
Our stores are for customers.
All right, there you got to make some money.
Our stores are for customers, and our stores are all about giving a great customer experience.
You've rebuilt the management team. You've changed how even the earnings call. You've made a lot of changes over the past year. Like, what have been some of the underappreciated challenges, for you in that first year?
Look, it's always not easy to change, I would say, culture and the way of working. And the way I find you have to do that, it has to be leader-led. And so it was really important for me to get the right people into the right jobs on my leadership team so that we could start cascading the way we wanted to work going forward. And I think we now have a great team in place. We still have, an area where we had our head of technology just retire, so we'll replace that role. But once we get that role replaced, and we've got our team in place, and now it's about driving culture. It's about executing against the strategy. And, I'm always focused on making sure I have leaders that in their respective area are world-class. And world-class both in the work they do and how they do that work.
Coming up, Bitcoin is getting beaten up as cryptocurrencies are on the decline. What's the relationship to U.S.-China trade and the drop? We'll explain when we return. Stick with us. Increased trade tensions between China and the U.S. have prompted investors to sell risk-on assets, significantly impacting cryptocurrencies. We're seeing Bitcoin, Ethereum, and XRP drop, with so-called October not going well for crypto. For more, we're joined now by senior reporter Inez Ferretti with more. Inez.
Josh, definitely October not going well for all of crypto. In fact, since last Friday, you've had the crypto market that's shrunk by 600 billion. And if we take a look at our Wi-Fi Interactive, you'll see the action here today. We are watching Bitcoin that is around 106,000. It had gone down to around 104,000, 105,000 earlier in the session. But if we just take a look, I'm just going to pull up here a 10-day chart. You can see down 12% over the last 10 days. We had seen Bitcoin at 126,000 at an all-time high back on October 6th. Then last Friday, Trump put out that social media post threatening China with 100% tariffs. And that's when you saw crypto really decline tremendously down to around 104,000 level. You had leveraged positions, you had long liquidations, and that really was what precipitated all the selling. Now you have had a choppy week, so to speak, over the last 5 days. But nevertheless, this has been a disappointing trade when you compare it to the likes of gold, for example. Even though gold is down today, I mean, gold has been sort of the safe haven. So even though today Trump talked about how the tariff talks are going well with China, and we've seen that the markets are up overall, but you're not seeing Bitcoin going up. So it's a bit of a head scratcher when it comes to some of the Bitcoin bulls out there, because this is supposed to be a strong month. And a lot of the big thesis has been that once gold had its rally, that you would see some of that money flowing into Bitcoin. We have yet to see sort of that rotation from gold into digital assets, cryptocurrencies.
All right, thank you, Inez. Appreciate it.
Thank you.
Regional banks facing pressure, with some smaller lenders taking hits from recent bankruptcies and investors watching closely for signs of broader stress. But Huntington Bank reporting a stronger than expected earnings report on Friday, posting rising loan growth and stable credit quality. Joining me now is the CFO of Huntington Bank, Zach Wasserman. Zach, it is good to see you. So let's start there. You reported results, stock higher here. Walk us through the quarter, Zach. What are you seeing in the business?
It was an absolutely terrific quarter, Josh. We grew revenues 12% year over year. Earnings was almost 20% year over year, and return on capital just under 18% year on year. And in our earnings call this morning, we raised guidance for the full year, another beat in terms of updated outlook for the full year. We just see a tremendous amount of momentum happening right now in our bank.
You know, Zach, more broadly, regional banks bouncing back here today, but we've had these questions about credit quality. Can you give us an update about just sort of what you're seeing there, Zach? What are you seeing in terms of delinquencies, charge-offs? What do you see now? What do you see ahead?
Yeah, in our business, we're seeing very stable trends. Charge-offs in the third quarter were 22 basis points. That compares with 20 basis points in the last two quarters. So really, basically a flat line. Likewise, in terms of forward-looking delinquency metrics, it's really very stable. You've got to look, at every portfolio, of course, but what we're seeing broadly is very, very stable and well-controlled credit. And it bespeaks something that's really important, which is fundamentally what we're seeing on the ground from our customers is strength, is resilience, continued orientation toward growth, very stable and traditional patterns of behavior in spending and borrowing, in their deposit activities, and it really underlies what we can see, which is continued economic expansion.
So these questions, Zach, about bank credit concerns in your industry with some of your peers, I think investors are trying to figure out still whether those are one-offs or no. Is this potentially canary in the coal mine, something more potentially systemic? What do you think?
I think we see these as idiosyncratic. There's been a number of news reports around very specific, often fraud-related credit issues coming out over the last couple of weeks. If you think about the banking sector, it's really in a very strong position since the great financial crisis. A lot of higher leveraged lending categories, for example, are no longer in the bank sector. They're more in private equity and in non-bank lenders. So, what we see in core traditional bank exposures is actually quite healthy. I do think, these fraud-related exposures are important to be mindful of, and clearly very rigorous and diligent client selection, portfolio management are the keys to really protect institutions in the face of that.
Zach, we're always looking for lines of sight into the consumer. You certainly have that. I'm curious what you're seeing. And does it depend, Zach, on which consumer we're talking about? High income, middle, low?
It does, Josh. What we've seen this year is really a tale of two cities, to use that term. Higher income consumers being quite resilient, spending activity continuing, a lot of demand for borrowing activity, and general posture toward growth. Lower income consumers obviously feeling more of the pinch of inflation and the cumulative effect of higher interest rates. For our business, we are largely doing business with higher income, mass affluent and affluent consumers. And so we're not seeing any of those pressures, but certainly as we look broadly in the economy, that's what we perceive. With that being said, the overall posture looks to be around growth. And I think it kind of comes back to ultimately employment. Employment is strong. We're seeing the trends be pretty stable there, and that underlies continued growth in consumer spending.
What about small businesses as well, Zach? I'm curious to see, what are the trends and themes there in terms of credit demand?
Yeah, and we actually have a very large small business division here at Huntington. We're the number one SBA loan originator in the country. So a lot of visibility into that segment. And again, what we're seeing is actually pretty resilient. Typical, for us, that business typically grows in the high single digits in terms of year-over-year loan growth. This year, it's around 9 and 10% in terms of what we're seeing in terms of trends. So continue to see demand for growth, demand for capital, and I think the uncertainty we saw in the environment over the course of the earlier part of the year, related to tariffs, related to the pace of interest rate reductions, that seems to have come into a new normal, and businesses are more into expansionary mode.
How about the housing market, Zach? I've had some pros on this week who say, effectively, we still look frozen here, but I'm curious to get your line of sight.
Certainly in terms of new purchases, the lack of supply is the primary impediment to more growth in terms of mortgage activity. But of course, as interest rates have come down a little bit, there is a pickup in refinance activity. For us, in the third quarter, we saw almost 20% year-over-year growth in mortgage origination. And so there does appear to be some sign of resurgence, but clearly the lack of supply is the biggest headwind at this point.
You know, the expectation from investors, Zach, is we expect the Fed to keep cutting. I'm curious if that's the case, what that means for your bank, and specifically, Zach, what it means if they're cutting because they're actually worried about this labor market.
Well, you hit the nail on the head. The reason for the cut is obviously very important, and that then affects ultimately how that manifests in terms of bank profitability. What we are expecting, I think it's quite likely now that we'll see another cut in October and then probably one in December as well. What's notable is we're seeing now is the shorter durated part of the interest rate yield curve is coming down, but the longer end is not coming down as much. And so you're seeing the yield curve steepen, which is actually very fundamentally a good thing for the banking industry. And so that's what's underlying bank margins expanding this year pretty broadly across the industry, and the expectation that they will further expand as we go into next year. So, it seems to be shaping up pretty well. Obviously, we'll have to watch to see the overall economic activity and ensure that there's no further weakening. But at this point, it looks like a pretty healthy setup.
Zach, final question. You're closing Monday, I believe. Correct me if I'm wrong, with that combination with Veritex. Remind us, what is that going to mean for your bank? And potentially, is there any more M&A on the table?
Well, we couldn't be more excited to welcome our new colleagues from Veritex just this upcoming Monday with the close. And, for us, this really is a springboard for growth for us in Texas. It'll make us the number 5 bank in Dallas. And one of the largest regional banks in the state overall. And so we couldn't be more excited about the growth opportunities that it represents. For us, look, we've got so much on our plate now to incorporate Veritex, to really make the most of that, and to welcome our new colleagues, and to focus on the really terrific organic growth we're driving. That's our focus at this point.
Zach, great to have you on the show. Thank you, sir. We are wrapping up today's Market Domination. Don't go anywhere. We've got you covered with all the action. Following the closing bell, stay tuned for Market Domination Overtime.